Hello and welcome to our latest fund manager interview. With me today is Margaret Lawson, fund manager of the SVM UK Growth Fund. Margaret, thank you for your time today.
Welcome, thank you for your time.
The SVM UK Growth Fund invests in best-in-class companies. Could you explain what is meant by this and the sorts of qualities that you look for in a business?
The key criteria when we're looking at companies, first I would say to you structural growth. That's the businesses that really, that can grow and perform, almost not say regardless of the economy, because obviously that's quite a claim in view of COVID, but that's very important that they're structural growth companies. We're really actually looking to identify management teams that can continually deploy capital well. That's really very important to our analysis. And that's obviously got to be supported by a good balance sheet, high cash conversion, because having high cash conversion means you have great optionality to do M&A, to invest organically in your business, or really just reward shareholders. So that's important. And obviously it return focus that you're covering your cost and capital in this sort of medium term. That's very important. And then we put all that together and really, and really see, what does that deliver? What's the upside in that from our DCFs, or, we use a sort of combination of sort of methods when we're looking to sort of value stocks. But really these are very important criteria, and really we use them all the time when we're looking at stocks.
And are there any common themes across the portfolio that you're seeking to profit from?
Well, I think, going into COVID, we were already very well placed there. You had the e-commerce, digitization, well-being. And obviously, I think a lot of these themes have actually been strengthened, even after COVID's passed. So, but I really think there's two themes I'd like to highlight in our portfolio, and that's one of sort of transformation. We're always looking for businesses that are going to sort of transform to be better businesses. And the other one is about really, innovation solves problems. That's always been a very sort of strong theme, in our portfolio. And then we've got category champions and we've got disruptors. But if I was looking at a common theme throughout that, I would say to you it's transformation. And as I said to you, that innovation solves the problems and that we have. And I think, the problems we have today are greater than ever, be it in health, be it in energy, being, how are we going to work? But what we certainly do know is the way we work, the way we live our lives is changed. And I think a lot of those changes will be long lasting.
The fund has just over 40% in consumer goods and consumer services businesses. Could you run through 3 companies that you have the most conviction in at the moment?
Yes. Well, maybe the first one's quite controversial. I have great conviction in Entain, which was formerly GVC. This is a business that's a world-class business now, has the best technology, is able to scale, and obviously looking at the potential of the US market. So I think it'll be a significant player there. And it was recently in receipt of a bid from its partner in the US, MGM. I think MGM will come back for GVC, but even if it doesn't, you've still got the structural trend of markets becoming more regulated. And it's not just about the US, it's about South America, it's about Africa, and it's really best in class companies. So I like JVC for the longer term there. Obviously the short term worries about the next budget, and about the gambling review. But I mean, this is a world class business, so, and as I said to you, the big potential is outside the UK. The second business I'd like to talk about is a business that again, it's an e-commerce business, and that's AO World. It's had a tremendous pandemic, but I think you're going to see capacity coming out. That it's a retailer e-commerce of white goods and electricals. But here's the business that's really come into its own as a result of the pandemic. Online growth in retailing was fairly subdued between 2015 and 2019, and obviously COVID has changed all that. And I think really just the model is scalability, and it's also its international path, because they're now expanding in Germany as well. And you're going to see Argos, they're not going to have any physical stores, and obviously there's problems with John Lewis as well. And Dixon's are going to have to shrink their estate there. So there's lots of market share for AO World, to address. So that's for me, that's an exciting business. But obviously it'll take a few years there, but that's one we like a lot. And the last one I would like to talk to you about is Jet2, which was a fantastic business going into this, and obviously cut off at the knees as a result of COVID. But there's a great proposition, a strong brand, a strong balance sheet, and I think it'll really return to its former glory at the other side when travel returns. And obviously, we're starting to see that we're starting to see that now. People booking holidays, and obviously it was well positioned for the fallout of Thomas Cook, because a lot of these brands have actually had problems. But I think Jet2, it has a great customer proposition, and I think it'll take significant market share, as this market recovers.
The COVID-19 pandemic continues to cast a shadow over the UK market. Has there been more chopping and changing to the fund over the past year in order to reposition towards the winners of the pandemic and away from those companies that have been hit the hardest?
I think there was at the early point in time, because we didn't have any visibility about what was going to happen to the sort of travel sector, hospitality sector. So we did take our holdings down there. But on the whole, I would say not, because we had very strong business models, with the Jet2s and with the Wizz Airs and with the Whitbreads, etc. So we actually supported the financing there. There's obviously been COVID winners, likes of Restaurant Group, that we've taken position in, because it's a better business going forward now than what it was in the pandemic. But on the whole, I think the nature of the businesses that we had, they were international businesses. A lot of them were very high value added businesses. So I would say to you, on the whole, there really wasn't much change. And a lot of the businesses that were fueled with, by e-commerce, and energy, we already had positions there. So that's really why that really contributed quite a bit. We weren't in the vulnerable businesses, and we were with the businesses that actually had a tailwind from COVID.
Has there been any evidence so far that the Brexit deal has led investors back to the UK market, or are investors waiting until the UK finds its way out of the pandemic?
Well, I really think this sort of valuation really tells the story in itself. The UK market is very attractive in PE ratings, or looking at EV/EBITDA. So I think valuation is very attractive. I think we have regardless of what's happened with Brexit, we have a very sort of dynamic economy here, very skilled labour force, very innovative economy. So really, I think that's what that I think that will be the draw. And we've got lots of of early stage companies that are playing into the new themes. So I actually think the UK is going to be a good place going forward. And it may take 5-10 years, to see these strengths coming through. But I'm very confident about the UK economy looking forward. And I think actually also, there's been quite a number of M&A deals, even in these early weeks of the year. And I think that's going to be a strong theme going forward. Even in our portfolio, with the 3 bids within January here, so obviously, they're attractive businesses here, and companies, strong companies, are going to use this opportunity, to get ahead. So I think it's a fertile ground, the UK market, for further M&A.
Margaret, thank you very much for your time today.
Thank you.